Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to be notified each time one comes out. This is my weekly thoughts on market happenings for the week ending January 7th, 2022. The TSX and oil were up for this week. Good job, Canada. The US indexes were down a little bit with the exception of the NASDAQ, which got hammered. Now, during the week, the Canadian economy added 55,000 jobs in December, according to Statistics Canada, beating expectations to close out a record year for employment gains. The unemployment rate declined to 5.9% for the month, the lowest level since the February before the pandemic. December marked a seventh straight month of job gains, with the country notching a record annual gain of roughly 885,000 added jobs over the course of 2021. ADP's December report on hiring at US companies, which was out before the bell on Wednesday, showed a job growth of 807,000 positions, more than double the estimates. This is indicating a strong economy and increasing likelihood of interest raises in the US. Now, the US economy added only 199,000 jobs in December. The increase in employment was well below Wall Street's expectations. Economists polled by the Wall Street Journal had forecast 422,000 new jobs. The unemployment rate dropped to 3.9%, however, and anything below 4% is considered full employment, showing that the economy is running on all cylinders. Central bankers and investors got yet another read on the health of the US labor market on Thursday morning. The government's look at jobless claims for the week ended January 1st showed a slightly higher than expected 207,000 initial filings. That's just about the same as the previous week's level, which was near the lowest mark since 1969. So things in the US job market are looking pretty good, again lining things up for the interest rate hikes. The big news for the week happened on Wednesday. The US Treasury yields soared on Wednesday, and North American stock markets fell sharply after minutes of the last US Federal Reserve policy meeting came in more hawkish than expected, flagging 3 or more interest hikes this year to quell surging inflation, and selling the US Fed balance sheet's bonds, thereby raising fixed rate mortgage rates. The selling off of the bonds on the Fed balance sheet will likely begin after the tapering is done and at the same time as the interest rate hikes start. Tech stocks, which are extra sensitive to rising interest rates, were particularly hard hit, with the Nasdaq losing more than 3% Wednesday and Shopify losing its crown to Royal Bank as the most valued Canadian listing. Rising interest rates increase borrowing costs for businesses and consumers, and higher rates can depress stock multiples, especially for technology and other growth stocks. Expensive stocks underperform cheap stocks in this environment. Rising interest rates tend to be good for financials, however. During the week, growth stocks took a hit because of the expected increasing interest rates. This is because as rates rise, the future expected cash flows of the growth businesses get discounted more when bringing them into the present, thereby lowering their present fair value using discounted cash flow models, and so they sell off. Next week, we have Aritzia and Tilray reporting earnings along with Delta Airlines and starting with US banks as well. Shaw is also reporting earnings as season restarts. The US CPI index comes out on Wednesday for December, so we can see what happened with inflation and whether the Fed will really start raising interest rates as everybody is thinking. That concludes my thoughts on the week that has just passed. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.